Next is a panel discussion entitled Reframing the Research Investment Discussion, Democratizing Investing in Humanity, Nature, and Carbon. Introducing moderator Bill Brandt of ASU LightWorks.
Hello everybody, can you hear me? Good, excellent, great. Well, we heard all about this idea of a team sport and how teams are supposed to play, but sport really gets exciting when the audience participates and we democratize the whole idea of winning a championship, and you can feel good about your home team and you can feel like you've engaged or whatever you've done in watching sport, or you've been twittering away. So the purpose of this panel is to start talking about, well, how do we democratize this idea that we've been talking about in AREDAY? And we are liking, can everybody hear? Good. And so what we're going to do is we're going to take you through a series of connected talks to talk a little bit about why we can think about democratizing carbon, why we think that there's opportunities there, and what is it that could happen as a good way of sort of finishing up for the day. So I've got on my panel Ellen Stechel, who's on my left. Ellen is with ASU. That's Arizona State University, LightWorks, and then Noah Deich, who's with the Center for Carbon Removal. And then we've got Mike Ferguson from Standard & Poor's Global, and then finally Matt Patsky from Trillium Investments. So we're going to kick this off by letting Ellen tell us a little bit about what's coming and what the possibilities might be around carbon.
Hi, can I tee up the slides? One thing I was hoping to try to do, and it's interesting that the last panel did steal one or two of our key phrases, and that's least technology risk was mentioned and innovation was mentioned in a prior. What we want to look at here is a little bit reframing the research discussion and a little bit about innovation, and move past just talking about electricity and then come back to democratizing. So just to kind of set the stage, I pulled out a couple of quotes that I think frame this pretty nicely. Every problem has in it the seeds of its own solution. So in looking at the problem, we're looking for the solution. And if you don't have problems, you don't get seeds. So we're looking for some new seeds. Each problem also has hidden in it the opportunity so powerful that it literally dwarfs the problem. And the greatest success stories were created by people who recognized the problem and turned it into an opportunity. And you'll hear Noah say a lot about this, that we're looking for the opportunity in the CO2 problem. And there's a lot of opportunity. And it was kind of teed up in the last panel as well. Kind of hinted at it. I don't know if everybody caught it. And inventing is seeing the same problem that everyone around the world is seeing, but looking at differently. So here in this panel, and especially Noah, we're going to be looking at the problem differently. So what problem are we talking about? Of course, the same problem everybody is, but we're going to especially look at it, the CO2 problem, that sources exceed sinks. And that we mostly talk about decarbonizing, but it's really sources and sinks, and we don't need to decarbonize necessarily. We need to balance those sources and sinks and do it at a level that is tolerable. So just some numbers to frame it. Over 2 trillion gigatons of 2 trillion tons of CO2 have been put out into the atmosphere since 1750. 880 have stayed, and the problem is, of course, the increasing atmospheric content and also the increasing acidification of the ocean. And greenhouse gases, about 76% of CO2, so we'll focus mostly on CO2. But there is the other, as I'm sure Klaus will remind me. So the vegetation and land, and there's lots of great places for sinks. It is a sinks, 35%, and can probably take up more. There'll be, has been discussion. And the ocean, 25%, but it's kind of acidifying, so that's not so good. So 3 trillion in total. There is 3 trillion tons of CO2 total in the atmosphere. We're going to look at that as a resource. It was 2,200 before pre-industrial. So we don't want to go below that. Beyond 3,500 is dangerously too much and probably lower than that. Cumulative emissions budget, if you believe you can go to 450 ppm, is less than 900 left. And what that means is if we started today, we'd have to decrease at 4.25% year over year, every year, till we finished. So that's 30% in 8 years and 50% in 16 years. Well, reality, we are almost certainly going into overdraft, and if we're not already. So thinking differently about CO2, getting to a circular economy, managing the excess as a resource rather than a pollutant is what we're talking about. And I want to point out, I probably shouldn't admit it in this audience, I come out of the auto industry, I love cars. And the automobiles are the most recycled consumer product in the world today. Just in the US alone, there are 7,000 vehicle recycling facilities. Automotive recycling is highly sophisticated and it's technology driven. And it follows manufacturing techniques. So what if we just created an industry at least that big and even bigger by recycling CO2? So think reduce, reuse, downcycle, recycle, CO2 circular economy. And only think to dispose if we absolutely have to. And we probably will have to, because we won't be able to use it fast enough because we haven't started soon enough, which is too bad. So recycling CO2 into the product it came from is one place. Now this is not going to get us to negative, but I will say we talk about decarbonizing the energy system, but we don't have to decarbonize the energy system. We have to decarbonize primary energy, which is different. So what we do in the energy system, we take primary to secondary to tertiary and finally at end use. Fossil dominates primary. That's where we have to get rid of carbon. That's where we have to decarbonize. But in the middle of the system, there's no reason. So hydrocarbons are not evil. We can use hydrocarbons in the system, and it does provide value to society. Hydrocarbons are very good at energy storage and are easily transportable. Today's primary energy, what fossil was, it stored ancient sunlight and it sequestered carbon. All we have to do is do the same thing, just do it faster than nature. And we can do that. We're mobilizing that carbon, and sometimes we hear that it has to go back underground. No, we can keep it above ground as long as we keep it out of the atmosphere and we keep it out of the oceans. So, I said that. So one of the ways, closing the cycle, airplanes do need hydrocarbons for the foreseeable future. Klaus tomorrow will talk a lot more about direct air capture. We can close this cycle if we take CO2 from the atmosphere and then convert it back into fuels and into non-combustible products or non-biodegradable. We can do this with or without biology. So liquid hydrocarbons, I say, they are good. They're energy dense, they're conveniently stored, they're transported economically, even over long distances. There's fast fueling, and we have trillions of dollars of infrastructure to do it. Electricity, great stuff, is best used when it's produced. And even if we got great batteries, it is not easily stored, especially for seasonal shifts. We don't talk much about what happens between winter and summer. Fuels can store seasonally. And it doesn't need, to do this, we do need investments in research and development. Solar fuels is what we talk about, which is biofuels without the biology, or we can do it with biofuels. They can be sustainable, and we do focus a lot on the economics. They can be affordable, but huge technical risk still, as was talked about. So it'll still need cost reductions through demonstration, pilot, learning, and scale up. And just like batteries are coming down, and PV have come down, and wind have come down, there's no reason why any of these other technologies can't get on a learning curve and also come down and eventually be economical, if we could get started. So carbon, coming back to the democratic. Carbon's highly versatile, and it's available everywhere. I'll just make this last point and end. It's essential for life, ensures a livable climate via the greenhouse effect. That's good. Greatest number of compounds. Carbon makes more compounds than any other element besides hydrogen, and it can do so with superior properties. It's been subject of Nobel Prizes. It can be the strongest material, the softest material, et cetera. We can put them into carbon composites. They're already going into cars. It's a matter of getting it affordable. And I will end there and just go. Oh, well, there's other industries that are gigaton.
Perfect, Ellen. That was very good. All right. So I'm reminded of that line in The Graduate where Benjamin hears the word, it's plastics, or is it carbon? So Noah, why don't you tell us a little bit about the story?
Yeah, thanks, Bill. It's great to be here, everyone. I'm Noah Deich, the Executive Director of the Center for Carbon Removal. We're a new NGO, and we focus exactly on what Ellen is talking about, how we take all of the CO2 that's up in the atmosphere and transform that into something valuable back here on the ground where it belongs. So I'll just speak up. So what we work on at the Center for Carbon Removal is figuring out how to unlock the value of that CO2 in the atmosphere. What Ellen mentioned is the technical challenges are real, but we have people working on them. What seems to be one of the bigger gaps is figuring out how to get society to value carbon that's in the air as something that we want to use for our manufacturing, for our farming and forestry, as we've heard earlier today. And I think the idea of carbon in the air completely transforms. So carbon in the air completely transforms our idea of what value actually is. So when carbon is in the ground, it's highly undemocratic. Companies are valued on the mineral rights that they own, how much land they have that they can extract carbon out of the ground from. But nobody owns the atmosphere. It's up to anyone to take carbon out using ingenuity and their ability to turn that carbon into value. And I think that's one of the key paradigm shifts about the transition from carbon in the air as just a waste and a pollutant into carbon in the air as a resource that can really drive our economy in the next century. And I think what that shift entails is really a rethinking of how we think about the carbon in the air. That we've thought about climate change as costs. It's all been about how much will it cost to stop putting CO2 into the air. But that's not how we sell things. We sell things based on value. How much do we value certain things? How much do we value taking carbon out of the air? And I think this is where we can get a real transformation in how industries all around the world work, in how forestry and agriculture, manufacturing and mining can basically transform our entire industrial system to harness the value of that CO2 in the air, to create more jobs, to create really new industries, and really flip that on its head. And I'll leave it with a figure that Ellen mentioned. She said that there were 2 trillion tons of CO2 that were put up into the atmosphere since the dawn of the Industrial Revolution. That to me is the largest mine that has ever existed. If you think of any normal carbon price, even say $10 a ton like it is in California where I live today, that is a $1 trillion top line revenue opportunity and can create businesses bigger than any that exist today for innovators and entrepreneurs that can figure out how to extract that value of CO2 from the atmosphere. And so I think that's a really key message that I'd like to leave everyone with, is as we think about what our economy is going to be and really what we value in that economy, that how do we start to think about extracting CO2 from the air and not just thinking of it as a waste, but really as the resource that drives the next industrial revolution and the next wave of economic growth and prosperity for generations to come. So thank you.
Thanks, Noah. Well, this is great. Ellen described the opportunity set and the fact that we've got industries that know how to reduce, recycle, and reuse. Noah's helped us identify what it is with that carbon mine in the sky. And we started off talking about this idea about, so how do we all participate? Is this sort of like a non-participatory sport, or can we all get involved? And of course, we know that we can get involved because investors are getting involved. We had a presentation earlier, we talked about divest. So let's talk about the invest side of it. So Mike, do you want to talk a little bit about that?
Gladly. Thank you guys for having me today. My name is Mike Ferguson. I'm a director in the energy infrastructure practice with S&P in New York. And I always have the good fortune of when we're working on new clean technologies to be able to work on these and to see them firsthand, sometimes to get insider information that we can kind of get a really good feel for the technology with. And I would say that part of what I want to talk about is how it is that we democratize the risk around some of these technologies. I'm a credit analyst, and risk is sort of the business that we're in, and it's an exciting one right now because there is a lot going on in this space that we're privy to. Now, while this technology is generally very exciting, I would say at its inception, new technology is not terribly highly rated. And I don't say that to be cynical. All I mean by that is that it's innovative by design. And when something's innovative, certainly there's a lot of upside in it. I'm sure none of you guys would be here if there weren't. But there's also potentially a lot of downside. There's a lot of risks that have to be identified, that have to be transferred in some way or another in order for that technology to really take off, in order to maximize impact. And I think that there are a lot of stakeholders here who are involved in figuring out how it is we should transfer that risk. I think the government is a large part of that. But part of it is that we want to make sure that we can transfer the risk to the people who can bear it, the people who want to bear it for a cost, and in doing so, we can minimize the cost of doing that and maximize the impact of doing that. Now, there are a lot of credit risks associated with this. I won't go through all of them in exhaustive detail because I know it's getting towards the end of the day here, but a big one is going to be technology risk. Certainly when we're looking at new technology, we have difficulty sometimes understanding what the costs associated with that will be and what the time frame to completion could be, all of which are data points that investors are generally going to be interested in. On top of that, we always deal with counterparty risk. Now, I work in the project finance space, but even the most tightly wrapped deals are always going to have exposure to outside parties. And the longer construction gets, and the more contractors and subcontractors and EPCs that are involved in this, the more complicated that gets, and the more we have to be concerned about counterparty credit quality over a longer period of time. On top of that, we deal with contract risk. Now, especially when you're dealing with new speculative type technologies, a big question for us is how much of the risk of construction is going to be transferred away from the project, away from the debt holders, and to the contractor. If you're dealing with innovative technology, I think you might find sometimes that EPC contractors aren't willing to take a lot of that risk. They can't get any visibility into cost overruns. They sometimes don't want to bear that, and a lot of times it resides with the project, and that can be a bit concerning for us from a credit perspective because what we're rating is the project itself. And of course, there's financial risk. Even if we have debt holders who at first glance look like they're willing to fund a project, the question is if the project goes longer than expected, if there are cost overruns, if there are change orders, are those same debt holders going to get cold feet and then potentially withhold funding? That's something we have to deal with. So these are all credit risks that make some of these projects a little bit more difficult to see as bankable right now. But the question we all have here is how we mitigate that risk. How do we democratize it? Who underwrites that risk? Certainly there are folks out there who will be willing to do it. For a long time in the United States, I would have said federal government does a great job of this. And in fact, the federal government did a great job of this, I think, for a long period of time. A lot of these renewable projects that have come up that now we rate investment grade, we might have looked at these things 10 years ago and said, this is speculative technology. This technology's got a lot of risk. It's innovative and it's kind of getting us to the carbon reduction goals we want, but who's going to underwrite this? And the government didn't necessarily write the checks, but offered the tax credits, backstop some of these things. And now that technology is competitive. Solar technology, wind technology, these are cost competitive with fossil fuels. And you might say that the next generation of technologies could benefit from the same sort of stimulus. The difficulty, of course, is that there's not a ton of transparency into whether or not the Department of Energy or the USDA or other departments are going to be funding this over the next couple of years. And certainly the next couple of years are very critical for purposes of decarbonization. You just have to look to the Paris Agreement to know that. So the question is who's going to step in? Who's going to fill that void? Now already you're seeing states, cities, big corporations, they're all jumping at the opportunities to be involved in this because they see the potential. They see the upside here, and they have the balance sheets to be able to deal with this. I mean, at the end of the day, look, we're looking, you hear lots of different estimates. one I hear a lot is $2 trillion of worldwide investment per year to create a sustainable, low-carbon economy. You need people with big balance sheets to make that happen. Certainly the federal government in the US, they've got a big balance sheet, but there are a lot of other players who would like to get involved in that as well, and I think you're already seeing sort of a groundswell of support for that. But then the question is that if you get all these investors who are involved in this, they want to understand the risks that are associated with this. And I would say that for things like I talked about before, credit risk, for counterparty risks, currency risk, sovereign risk, the market knows how to price those things in, right? I mean, certainly those costs can be considerable, those risks can be considerable, but there's a basis point. You know, on Wall Street, that's what we deal with. That's our currency, basis points. You know, a project in Spain versus in the UK, that's a premium of X number of basis points, and everyone kind of understands that. One thing the Wall Street doesn't understand quite as well is sustainability risk. And the reason I bring this up is that I go to green bond conferences all the time, and I talk to portfolio managers, and they all tell me the same thing. They say that intuitively they know that they're investors, that they want green investments, they want sustainable investments, but the conflict that they have is that they have a fiduciary responsibility to maximize return and minimize costs. They say, I've got a dozen guys on my staff who know all about credit risk, they know about sovereign risk, currency risk, and all these things. They went to business school to do this. They got their CFAs to do this. We don't have anyone on staff that does sustainability risk. The information cost there is too high. And part of what we're looking to do at S&P right now is to reduce that information cost. In recent months, we've released what's called the Green Evaluation. This is what we're doing here is looking to go beyond green bond principles. We know that the green bond principles are effective, and labeling green bonds is effective, but at the same time, it doesn't tell you how much of an impact you're making. And we think that the investors of tomorrow, millennials, as we talked about earlier, are going to be really interested not just in what the return is on those, but on the sustainable impact that they're having by making that investment. That's going to be part of their bottom line as well. So if you guys have any questions on green bonds or green evaluations, I'll cut it off here, but please feel free to come up to me because we're doing a lot of work on this. We think that it's something that's very important and influential going forward and something where we hope to be a participant in the dialogues going forward.
So I just want to say here, Mike, that's like totally terrific. And you know, sort of thinking about how people in this room can participate. We're all investors, right? Yeah. Now, what happens if I go from an old analog dashboard of, you know, my speedometer and my gas gauge and something else? What are you and other companies like Bloomberg and S&P doing to help investors see a bigger dashboard, a systems dashboard?
Sure. Like I said, I mean, part of what we're involved in right now is doing green evaluations, and this is something that goes beyond credit risk. This is something that's not even involved. It's not even part of our credit ratings. It's assessing strictly sustainability risk. We have a tool on a standalone basis that does that now, and part of the reason that we do that is we know that today's savvy investor, and especially tomorrow's savvy investor, wants to see another data point. They don't just want to see what the credit quality is. They want to see the impact that they're having. So I think we're just providing additional data. Now, we don't have a lot of these right now, but hopefully at some point we will. And I think that provides a basis for comparison in the same way that ratings have done for us for 100 years.
So I just left my 1929, you know, sort of single digit, you know, thing to, I've just gotten in that Airbus or that Boeing jet. So Matt, what can I do with that?
Great way of asking the question. Mike did a great job of just talking about risk factors. I will say, by the way, I'm the CEO of Trillium Asset Management. We manage about 2.7 billion of sustainable investments. So for about half for individuals, half for institutions. We manage money for institutions like Sierra Club, their endowment, and Amnesty International's endowment, just some names people know. But when the firm was started in 1982, the belief was sustainability would become mainstream and that people would look at environmental and social impact as factors when they looked at investing. And it is true that what's happening now is major data providers like S&P are now providing enough quality information that it really has started to become mainstream. So we're seeing sustainability characteristics increasingly being demanded by the subscribers of data from S&P, and so we're seeing a lot more data coming from S&P, Bloomberg, MSCI, and the like. And just as far as risk factors are concerned, I would just say we, for the primary portion of our assets, do not take technology risk. We are invested in technology, in companies that have already proven technology and are already large, predominantly publicly traded companies, and trading in their debt. On the debt side, we've moved to over half of our fixed income assets being in green bonds. and have continued to be aggressive in trying to push those standards and for more issuance of green bonds to fund projects. When we're looking at really what needs to happen, what we have to step back and remember is the largest portion of assets are on the fixed income side, and we need to see movement on the fixed income side. So we've been now trying to look in conjunction with others looking at, well, what mechanisms could government play a role in trying to trigger mass movement of more dollars toward more renewable energy projects, more green energy projects. And so that's been sort of a focus for us recently.
Right. So you've been on a panel with the clean tax cuts, right?
Correct.
And what would that do if you suddenly looked at that and said, equity investors, fixed income?
Right, right. If you look at institutional investors are looking at the risk return characteristics, and by changing the tax treatment, it's going to improve the return characteristics. So flow of capital would expand, right, if we had clean tax credits or clean tax cuts. But on the more important to me in terms of looking at this whole opportunity is if green bonds became in reality treated with special tax treatment, the flow of capital would be substantial, right? Because there would be an awful lot of people who may not care about sustainability, for whom the differential of that return characteristic relative to the risk profile is going to move the money in that direction. And if you remember the numbers from the last panel, it's $5 trillion just to comply with the Paris Accord. That's a lot of money.
Yeah.
And we don't have a lot of time. So we have to start thinking about what can drive a lot of change in the way in which money, investment dollars are flowing in the near term.
That's fantastic, because all of a sudden you can begin to see that it's possible that green bonds might actually trade at a premium.
Right.
And Apple just did a huge green bond analysis. Any comments on that?
Yeah.
I mean,
I'll take a quick stab at this if I can.
Yeah.
Certainly, that's I think is a data point that needs to be seen, is that there is a pricing premium associated with green bonds. The difficulty, at least in the U.S., is that largely green bonds have been in the investment grade space, where pricing premium margins there are so thin as it is. The spreads there are so thin as it is that it's kind of hard to identify that. And so far, it's been positive evidence, but largely anecdotal. And I think as you get a larger population of green bonds, that premium will be borne out, especially if you start moving into the non-investment grade space where there is, more substantial spread to begin with. I think that that premium will become very, very apparent. And I think it's irrespective of, frankly, what's going on in the U.S. with regards to climate change policy. I think that this is bigger than that, and I would expect that that'll shine through.
The time horizon is much longer than the current administration's likely time in office.
Right. Yes, there is something about these time horizons and things like that. So, Noah, what are your thoughts about how finance and some of these things we talked about contribute to this carbon mine in the sky?
Sure. So I think there are a couple of different aspects of where we are in the finance chain that really matter. So a lot of the early stage technology is just too far away from the green bond market to make a real difference. And for those types of solutions, we really need to figure out new innovative ways to get money into research and innovation. And what we know is that has to come from the private sector now, from companies, from investors, from philanthropies, all of the above, because our current administration and government is pulling away from that. Where I think there are a lot of really interesting opportunities on the later stage capital are around land management. And that what we see today is land managers are already facing significant pressures for the value of their assets going forward. And if there are ways for finance institutions to figure out how to not just deal with some of the changes that are happening because of climate change today, but are actually able to be part of the solution and use land as a tool to sequester carbon out of the atmosphere, then that can unlock a lot of value in that land where we're facing some fairly serious generational shifts right now. That farmers are in their 50s on average and are looking to hand over their land to the next generation, who are looking at these assets, and the younger generation is seeing that this is very difficult to make a sustainable lifestyle out of with these increasing headwinds. So if there are ways to figure out how to unlock this potential, not just on equities and debt, but in the real estate market, I think that's key. And just in general, I think the one thing that we're going to have to keep in mind through all of this is, what is market rate return and what do we need to do to actually solve the problem? Because all of the investors that we're talking to, they really want to figure out things like solar and wind and efficiency, and where has all of that risk been taken out of? Where have we commercialized these before? And we can sort of win-win, make our commercial returns, and do good for the planet. But there's a lot of things in the bucket of solutions, not just in how we clean up carbon, but how we stop emitting carbon, that are not quite at that rate, and that place in the financial maturity, if you will. And figuring out how we can develop new structures that really see the long term, and that we're investing in the long run and not just shooting for these quarterly earnings targets, that is going to be critical for unlocking the trillions of dollars a year in capital needed to get to where we need to go.
So I can see both of you down here want to say something, so go.
If I can, I think that one of the things we benefit from in the United States is we do have this federalist system where we don't necessarily have to rely on the federal government. I think a lot of the states are putting in place tremendous incentives for things like battery storage, which is next generation, offshore wind, which is next gen, at least here is next generation. And I think it makes good sense for them from an economic perspective, right? Because I saw something in Maryland recently where Maryland, they allowed 2 offshore wind leases, and part of the condition associated with that was that the two companies, Deepwater Wind and can't remember the other one off the top of my head, those 2 companies had to basically fund an infrastructure site for offshore wind development in Maryland. That was part of the condition of getting the leases and getting the approval and getting the state incentives. So now, if this takes off, if offshore wind becomes economical, Maryland is going to be a leader in that. There are going to be jobs in Maryland because of that. So I think that in a way, you almost have competition among states to be the best and to be better and to provide the right incentives to spur development. And I think it's a lot of different technologies. And I don't think you can break it down to a red versus blue issue. Frankly, I think all states could benefit from doing this. I think it's just smart business. I think if jobs are the most important thing to you, like for a lot of governors it is, then this is kind of a no-brainer to start funding this and finding what the competencies are and putting in place the incentives to move in that direction.
Thanks, Mike. Matt, what were you going to say?
There are a number of private funds that are focused on land management, and farmland LP is one that we've had clients invest in. So there's when you talk about requiring market rate return, this is a debate that comes in all the time within what is now being coined impact investing. And the reality is there is a spectrum of opportunities, some of which require below market return in order to provide that catalytic capital to get a project to scale. And so there is a lot of activity that goes on where you are looking at the needs of a client in terms of return characteristics, the risk they can tolerate, and then making decisions that they can put money to work in a root capital, which is developing agricultural, organic, sustainable agriculture projects in very vulnerable regions of the world, particularly Latin America and Africa. And that happens to be a place where we have a lot of loan capital, right? It is not market rate return. And we would never put a client who needs market rate return for their retirement in it, because the risk profile, certainly doesn't warrant lending money out, 5 years at 3%.
So, essentially, you can do this partly through clean tax cuts or something like that to sort of change I'm going to call it the return required by the investor, because the government chips in.
Right.
The returns and the risks that Mike talked about earlier are all there.
Right.
So this creates some new opportunities to rethink how we deal with local, state, federal, in thinking about that whole tax package and how it all comes together. But what I'd like to do is I'd like to pick up the front end of the technology, section, Ellen, And just to ask you your thoughts about, okay, so we've got a gap in the federal government's willing to step in with new technologies. How do we fill that gap?
Well, especially on the end of, if we want to manufacture either fuels or carbon composites or something like our carbonates and ceramics, and starting to displace steel or concrete and get a lot more carbon products into the infrastructure, nobody is really working on that. But you look at the oil and gas, and we've talked about earlier that they're going to have to leave a lot of assets underground. And they're not going to just go quietly into the night. So if somehow some of the tax incentives could also, you know, it could be a future industry for them. They have a lot of the right competencies. You know, it's a lot of it is in their wheelhouse. So if they're going to have a future, and it's clearly not going to be from digging it up unless we're going to destroy the earth, then that's where we seem to need to look for. But they need also some incentives, whether it's tax incentives or something, to start pivoting in that direction. Because right now, you know, government, industry, pretty much nobody is funding this, trying to actually turn CO2 into value, other than perhaps in the soils, certainly, in agriculture, but not in manufacturing and not in the fuels infrastructure. And to say they have the assets, they have the infrastructure. They need some motivation, maybe.
So there's an innovation engine that needs to be going on here. Noah, you were gonna.
Yeah, and can I just add to that today hundreds of billions of dollars are spent by oil companies looking for more oil. The fact that we're still spending that much money on exploring for new fossil sources, something's broken there. That we have to figure out how to hedge this carbon bubble that is coming, which is not a question of if, but when, and figuring out how to turn the CO2 in the air into valuable resources is actually highly aligned as a hedge to many of these existing companies' businesses, their core competencies. I think part of the reason that we don't see big oil companies making solar panels today is because they're not good at making solar panels. They're good at, they're chemical engineers, and they're good at the geology and chemistry of transforming oil into useful products. And what we're essentially saying with the carbon transformation is, let's just do that in reverse. Let's figure out how to apply those same skills to, instead of extracting CO2 for value, is to pull it back and make that our value stream. And thinking of it in this way, there is so much value in that end prize for these big established companies that it's not unreasonable for them to start investing in this early stage R&D today. And the president of Arizona State University sees this clearly, and he's in his quest to make new industries and new economic opportunities for people all across America, sees this as the next learning frontier for our economy and our society. And it's just figuring out how we make that vision something that's shared more broadly across a wider set of stakeholders. I think we can actually motivate the level of resources, because we're not talking trillions of dollars every year to do this innovation. We're talking tens to hundreds of millions, which is still a lot and a heavy lift, but it's something that's well within the purview of existing players in the ecosystem today.
That's great. So I'd like to ask the audience for any questions that they might have of the panel. We've got a couple questions here and one question there. So we got a microphone. Wes?
So my question is to anybody on the panel is, if we actually got an escalating carbon tax in, one that was predictable for the future. So let's say, $200 a ton to $400 to $600 to $800. How would you in the investment community, would that change the way you evaluate your projects? Would it completely obliterate the investment returns for your clients? Is it feasible to put in such a carbon tax from the perspective of the investment community?
If it were politically feasible, it is certainly feasible for the investment community to process that into our evaluation. I mean, we happen to have been calculating carbon footprint since 1982. So we've been looking at lower carbon footprints on companies since we've been investing. So it would be an unfair advantage for the way we invest. And I would love to see a $400 tax tomorrow, but I don't think politically we're going to get it. So we sort of look instead at what are the other options that we have to try to put in place some kind of a mechanism to have the market put in a value for carbon. But yeah, it's a great question. The market itself would adjust. I don't know whether it could immediately take the shock of that high a price right away, but certainly signaling a price and then having it be predictable is what the investment community would need, and I think what companies would need in order to be able to plan.
Great, thanks. Can I just get a question over here?
Sure, hi. I think Wes took my question there because that's exactly what I was going to ask. My name's Aleem Sheikh. I'm from Scotland, as you can tell from my name. I work at ASUs with some of my panels members here, and I work for the chairman of the Julianne Wrigley Institute of Sustainability. I saw Juliet. Hi, Julianne Wrigley. How are you? Anyway, my question is a little bit different now because Wes took my question, as I said. So look, we're talking about democracy here. Let's change it. I lived in China for 13 years. I speak Mandarin as well. Now, I'd like to ask you guys, sometimes the time for diplomacy isn't now. So let's just change it a little bit. And I'd like to ask the 4 panel members, Bill, if I could, that if the time for democracy was over and we were now living in a communist world, if you were the leader, what action would you take and why? Thank you.
So,
He's jumping right on it.
Noah, why don't you take that?
the first thing I would do is restore democracy, because that's a ridiculous question. I think it does have a good point that the United States has really stepped back from the international scene in its leadership in advancing new climate technologies. And I think it actually links to the point earlier where the question isn't what would happen if there was a carbon price. It's what do we need to do and what investments do we need to make so that a carbon price is politically feasible and politically salient. And how do we start to invest in the types of community programs around climate-friendly solutions so that people go to the polls on climate change? In the United States, they don't today. And you can't change that by just telling them more climate facts. We have to actually figure out how to give them part of this economic opportunity that we see. And that's where the democracy argument, to me, is biggest. I think there are less than 100,000 coal mining jobs left in the United States. And it's this huge outsized influence on our politics. And I think what we have learned from that is that we have to figure out how to get better jobs that are climate friendly into the places that are most hard hit through fixing the climate problem if we want to actually build the political will around the world to get to these common end goals.
Well, I want to take the microphone and thank the panel for an amazing discussion and for answering your questions. I know there's some questions out there, but I've been given the sign. And so we're going to have to end it. So thank you very much, everybody. I really appreciate it. And thank you to the audience.